Good morning, good afternoon, good evening, depending on where in the world you are. Welcome back to the Real Estate Standard live stream, episode 4. I'm Tim Kotzman. I'm here with Kenny and Chris, and we're going to talk more about a term that Kenny invented today called digital rent. So, Kenny, what is digital rent?
Hey, Tim, thanks for the intro. And digital rent, it's a phrase I coined because digital credit has been kind of difficult for a lot of people to understand. Um, credit in business terms means when you're kind of lending money, whether you have credit at a store or you have credit at a restaurant or whatever. But in business, when the buyer buys the credit, they're buying a revenue stream. And I think that's like the missing kind of piece. And so when I look at these digital credit products that Strategy has issued, Stretch, which I think is the closest to digital rent, it's a revenue stream. It's a monthly predictable cash flow that you're purchasing. You're locking in the cash flow at the time of purchase. And this one's a variable rate in interest. So every month they're going to either increase or decrease. So one thing I wanted to talk about today is what a ideal commercial real estate digital credit product looks like, and that would be digital rent. Um, it's just a predictable cash flow that is derived from Bitcoin. Bitcoin's the digital capital, the at the foundation layer. And over the long term, Bitcoin is going to appreciate. I think most people will agree that. We're going to go through this very high period of inflation, where inflation is just rampant, and most assets will increase and appreciate in value. And yeah, I'm kind of rambling there. I don't know if I'm explaining it well, but Chris may be able to summarize it for us.
Sure. I mean, digital rent. I love that term. I love that you coined that. And from a real estate standpoint, I mean, you think about all the different ways that owners are looking to diversify their income streams just on a single property, right? You have your traditional cash flow from your tenants. Some investors like multi-tenant buildings as compared to single tenant buildings, and that's because there's a diversified income stream there, and it's a way to hedge their bets when it comes to different vacancy situations. The next step there is paying for parking, paying for getting an income stream from a cell tower, paying for different amenities on the at the property. There's all these little different ways that owners and real estate investors are trying to optimize the NOI of a property by charging rent, essentially. And what you're doing here with digital rent is you're creating a new income stream that further diversifies the property and ultimately makes it more profitable. And in our views, I'm kind of speaking for the three of us here, it de-risk the property to some extent, just because of the nature of the instrument. So that's how I'd like the real estate folks to look at it, as is a new income stream that improves the diversification and makes the property a little bit more resilient to navigate the environment that we're currently in, and that we're going to find ourselves at least through the rest of this decade. And that's the inflationary environment that you alluded to, Kenny. I don't think a lot of people are ready for another 3-4 years of this, let alone having it increase. So get
Yeah, and I
yourself some
wanted to
digital rent before it's too late.
yeah, and I wanted to kind of dive in, like, like an ask you, and like it's an open-ended discussion. If you were to create a digital credit product and you wanted it to be geared for commercial real estate and you want it to be digital rent, how would you structure that? Because I look at all the different preferreds and I see things that I like about each one, and I see some things that I don't like about each one. Stretch is great because it's monthly, but as far as from a real estate perspective, that variable rate is is scary to a real estate guy because it's no longer predictable. What are the digital rents gonna be in year 3? You don't know if it's good. I mean, it could be better. Maybe they turn it up and it's at 10 or it's at 11, so maybe it's at 12 or 13%. But if we go into a zero interest rate environment, there's a good chance that those trend down from 11% to maybe 8% is looking juicy when you're at a zero rate interest environment. And so the other preferreds like Strike and Strife and Stride, they're all fixed returns from the time that you purchase them. So when you purchase it at, say a par value of $100, Strife is going to be a 10% return. And you know that it's going to be 10% 3 years into the future. Now, you had mentioned early on in one of our first episodes that you thought STRK was the closest to real estate because it had the two components. It has the conversion, the 10-to-1 conversion component, and it has the dividend, the rock dividend component. So you have the cash flow, and you kind of described it as like you have your dirt or your land, and then you have your building. And the nice thing about Strike is there's room for appreciation. Strike isn't going to be held down to a $100 par value for forever. It's got this 10-to-1 conversion component that I keep mentioning. So that means in 10 years, if Strategy's common stock, MSTR, is over $1,000, there's a reason for Strike to trade over 1,000 because it's 10-to-1 conversion. And then plus it has a dividend component. So even if the common was at 1,000, there's a justification for it to be over $100 par price. So you have appreciation, which commercial real estate folks are familiar with. Their properties appreciate year over year, and that's something they count on in their back pocket. So with Stretch, you have no appreciation, and so I kind of wish that you could pull certain attributes from certain preferreds and bundle them together. The monthly payment is my favorite part about Stretch, that it occurs, the frequency is much faster.
Mhm.
And so I'm just curious how you would structure it and what you think about that.
Yeah, I think it greatly depends on what you're using it for. If we're talking about this digital income stream, this digital rent, and it's part of your capital strategy, STRC, I mean, I don't know that I would really make any changes or enhancements to STRC because at least as I understand it, I mean, yes, the interest rate is variable, but it's variable within some boundaries, right? If it's going to go down, below I think 99, they're going to juice it back up to that $100 level, and the interest rate will reflect that accordingly. I could be wrong, but the way I understand it is you're not going to have an STRC that's paying 6 or 7% or 14 or 15% for that matter. It's going to be a little bit more confined. So if you're a real estate operator, yes, the monthly frequency is incredibly important because when you use this as part of the broader when you implement into the broader strategy and you go to maybe take a loan against it, or refinance, whatever you're doing, the lenders that you're working with, they're going to want to see a monthly cadence rather than a quarterly cadence. So you're spot on there. And again, when you're using this as a treasury strategy, whether it's digital rent or just a way of preserving your purchasing power in a inflationary environment, stretch is perfect by me. If I'm being nitpicky, I'd say you would want to see it be held at that $100 level, just that much more. Your comments on Strike is interesting. I look at Strike as kind of the digital real estate alternative to your traditional real estate, because as you alluded to, the $100 liquidation value, I view that as like your land value, right? Your 8% quarterly payment is your cash flow stream, and then the conversion option sometime in the future is your option to sell at an appreciated price, right? That's digital real estate. And a lot of real estate investors like real estate because that land value component is kind of like a built-in stop loss. The building burns down tomorrow, worst case scenario, you have the land left, right? And you can figure out what to do with it from there. So does the STRK product replace an STRC in a capital strategy for a real estate property? I'd probably make the argument no, at least for today. That could change in the future, but I think we're so early on all of these different vehicles and mechanisms that walking before we're running is important. And I think with your comment, Kenny, on the variability of the interest payment, that's one of the things we have to figure out, right? I mean, we're still not even on a full year anniversary of these products, so we're blazing a new trail here. And I think if you introduce STRK today into the capital strategy for the real estate, the traditional real estate, I think you might be getting a little bit over your skis and dare I say greedy. When you just introduce risks you don't need to. I think you have the returns in place that are far superior than everyone else in the market to begin with.
Yeah, I mean, I think we're gonna need to have somebody that's been covering the preferreds a little bit closer than both of us come on and kind of dissect this. I think we have a guest lined up that might be able to help us do just that. I'm gonna push back because I'm trying to think of the overall picture here, and I think that when you talk about digital rents, the next step of digital rents is financing the digital rents. You have digital finance that is going to be part of this puzzle. So what we've seen, just within the space, uh, it seems like some of these digital finance partners are going to want to have some upside, kind of like profit sharing. That's another thing I wanted to talk about. We had talked offline about how Bitcoin and digital rents, they're going to enhance the property, how the property owners are going to be able to make better improvements, be more selective about their tenants, and just create a better atmosphere for their property. And one thing I thought about after we spoke about that was it's not, you don't really see it too much, but I have seen over 10 years ago, a lease where there was a profit sharing lease. They're
Mhm.
not too common anymore, but a landlord will, give say they have a vacancy and they're trying to fill the spot and they can't really fill it. They may be willing to give somebody a shot, an entrepreneur a shot that's going to open a restaurant. They're going to do something, and instead of the unit sitting vacant, the property owner may say, "Hey, we'll do a very low base rent, and that's basically covering the property owner's cost or maybe slightly less. And then we're going to do some profit sharing. So after you cover your cost, we're going to split the profits. And I could see where I kind of got off track, but I'll try to loop it back. I could see a future where the tenant mix is based off what the property owner wants in his or her community. So if you have a property that you take pride in, and you have some kind of jerk tenant that has been a problem, well, the digital rents might start kicking in and the Bitcoin treasury might start kicking in. You can be more selective, and you can say, hey, I've had enough of this guy. His lease is coming up next month, and I'm not going to renew it. I'm going to throw him out, and I'm going to take in a tenant that I resonate with more, and I think it's better for the community. And so I wanted to mention that, but also back to these digital rents and whether Stretch is the perfect digital rent or not. One thing with it is I'm not confident that the yield is going to stay where it is. If we go into a zero interest rate environment and the best performing bonds and things are down at 4% or less, Stretch would be oversubscribed at today's levels. So like it would be going through the roof, it'd be going through 101, 102, and they would have to lower the interest rate to strip that outsized demand away. They would have to basically hammer the ATM, issue more shares at 100 to kind of bring that price down. And the only way I see that they could do that is lowering the interest rates. Kind of rambling here, but yeah, I don't know if you want to comment on the selective tenant screening and kind of creating an atmosphere where the property owner is in control and can be a lot more selective of the property. And any rebuttals on the Stretch?
The selective being the having the ability to be more selective on deals is a superpower, and it's underappreciated and it's under talked about, frankly. Whether you're looking at acquiring and disposing of assets, that I think that's where most people focus on is that level. But to what you're talking about is being selective on who you're leasing to. That's just as important, if not more important, than deciding on what you're acquiring and what you're disposing of. Because at the end of the day, the tenants are everything, right? The tenant is the lifeblood of the commercial real estate. And whether it could be a one-off tenant, but it's typically the tenant mix and how cohesive is that tenant mix, right? Do the different business operations and business ideas, do they play off of one another and complementing one another in a positive way, or are they just creating friction, right? And you could have a great property and you could have a dozen tenants. If you have one tenant that just isn't vibing with the environment or the other tenants, it could throw the entire property off. So it's incredibly important to have that selectivity on your deals, and not just slam on a lease deal because they have an immediate commencement date, or they have low tenant improvement requirements, and you're just trying to get someone in there that has a heartbeat, right? I mean, that's how people make bad decisions and get caught with their pants around their ankles. So I want to talk more about this, and I'm sure we will in future episodes, but being selective on deals makes the properties run better. It also creates a more like anti-fragile asset class, because I've mentioned this before. If you're an acquisition guy and you have $100 million to deploy over a certain period of time, if you don't use that, or you don't put that $100 million to work in that given period of time, not only do you lose it, but you're not getting your bonus, right? So these acquisition guys are under pressure to deploy the capital regardless of the quality of the deal. So again, going back to the phrase, show me the incentives, I'll show you the outcome. There's a perfect example. And I'm not saying that these guys aren't being thorough and they're not doing their diligence, because they are. But what I am saying is, if the incentives were better aligned and maybe they had that breathing room and the leisure to be more selective, they're going to be a lot more prudent about when, how, and where they're deploying their capital, their investors' capital, and into what asset, and what is the strategy for that investment. And when you do this at scale over long periods of time, it creates a more resilient and anti-fragile asset class. The peaks and the valleys, throughout cycles become less sharp, less dramatic, and I think that's good for everybody. Whether you're the investor or the broker or the property manager, the developer, to smooth some of that volatility out is a good thing.
Yeah, and you got me thinking too. We keep kind of building on these ideas, but I start thinking in the future, if the digital rents and the Bitcoin treasury are doing the heavy lifting for you, you no longer have to like squeeze lot coverage. Like when you're like designing the property layout, you're putting in the minimum parking requirements. You're trying to get the building as big as you can. You're trying to maximize the space for square footage and for rent. And sometimes that can mean the property doesn't look as nice, or the layout is kind of funky, or it just has it just looks crammed. You see some of these parking lots, right? And they're like nightmares. You pull in, you don't even want to go to some of the businesses there, because the parking is just a nightmare. Where you're, um, so I see a future where it lets the property owner really take control, especially with things like electric vehicles being part of the future. If you're going to have electric vehicle parking, maybe you want to have like a private kind of park or amenity for the plaza. I mean, a lot of like shopping malls will have like, kind of community areas. But if you're just a retail shopping center, or just a small plaza, you can create some features that just make it a whole different kind of atmosphere. You can charge your car, you can get a coffee, you can chill out and relax, and you don't feel like you're in and out of the place. I feel like a lot of commercial real estate, you just want to get out of there. You just want to get in and out. Um, but with the whole electric vehicle thing, you might want to charge up for 30 minutes or an hour. So you're kind of like sitting on the sidewalk on some bench, and you're just like, ugh. Property owners can make that all come together and feel nicer.
You're exactly right. I mean, you took my point and just furthered it, right? I mean, if you don't, one is the tenant mix and how well those tenants work together. But, for the consumers, what's the experience like when go to and from the property, right? I mean, real estate, ingress and egress, the accessibility of the property is critical, particularly in the retail environments. That's an entire niche area in itself in retail, is accessibility, where your curb cuts are, how many curb cuts you have, what side of the street it's on. And so, to your point, you have a lot of properties that you can tell that they just cut corners. They slammed some kind of building onto the parcel in a way that maximized the square footage. It didn't necessarily optimize for all the other components. And, now that property suffers because of it. The tenants suffer because of it. The local community that it's located in, suffers from it to some extent as well. The another thing, going back to the digital rent component and being more selective, is just thinking about what it takes to fill a vacancy, right? And I want to just put an asterisk here real quick and say, this depends greatly on the type of property and the market environment you're in. But in my market, in my world, to backfill a vacancy can take 12, sometimes 18 months, depending on the size and depending on the market condition. And once you find a tenant that's ready to take a space, it doesn't happen overnight, right? It's not like you go lease an apartment, you sign an application on Friday and you can move in Monday the following week. When you're talking about these retail centers, the office buildings, the industrial centers, industrial facilities, a tenant approaches you on, maybe a 20, 30,000 square foot industrial unit today, that tenant is likely moving in Q4 of this year, right? They have an 8, 10, 12-month lead time before they get into the space. There's upfront capital that the landlord is fronting in the form of marketing dollars, broker commissions, tenant improvements and refurbishment costs, as well as just the general carry costs of the property, right? And when you add all these numbers up, all these line items, they can very easily get to 20 or 25% of the total lease value, right? So you think, let's say, you just, for round number sake, let's say you have $1 million lease value, and day one, just to get that lease consummated and a tenant in the space, 200 grand of it is going to that effort, right? So this just underscores how challenging, how competitive, and how capital intensive real estate properties can be. And bringing it full circle to this digital rent concept, if I have a certain percentage of my treasury in a vehicle like Stretch that's paying me monthly, right, on the cadence, and it's paying 10%, that's meaningful. It falls directly to the bottom line from a profitability standpoint, but it gives you that ability to weather that 9 or 12-month period of vacancy and get through that lease up exercise, and all the costs that come with it. So that is an incredibly practical and tangible example as to why and how the real estate investors need to be, exploring these products.
Yeah, my brain's going a million miles an hour now, just thinking of all the amenities and things that could be added to a property to make it, like, make the community better. And I think Bitcoiners, that's what they really want to do. They want to make the world a better place. Most of them, there's an expression in the Bitcoin space. Bitcoin fixes this, and I think Bitcoin can fix real estate. It can fix the the feng shui of the property. It can fix the look, the architectural designs, the layouts, the tenants. Um, you know, Sometimes you might have to lease to a tenant that you're unsure of. Maybe you're not a drinker and you lease to a liquor store, and you're like, hey, I don't drink and I don't really want this liquor store in my plaza, but I need to pay the mortgage. Um, that's kind of a random example, but maybe you're a tennis player and you rather see a tennis shop there, and yet a guy that's trying to open up a tennis store, but he's struggling to find a location, and he might not have the money to do the improvements, and you're saying, hey, I'll help you get started and do some profit sharing things, a profit sharing lease, it's going to be like a whole new way to do business in my view. I think the the boilerplate leases that you see nowadays are going to be a thing of the past. It's going to be a more personal experience dealing with your tenants. You're going to want to work with people that you admire or that you like to deal with, because as a landlord, you're going to visit the property. You're going to make sure the property's up. You know, at least us as a smaller West Main Storage and our family office as a smaller real estate operator, we know all of our tenants. We have 64 retail shopping tenants, and we know all of their names
Yep.
and their employees, and we're friendly. And I think that connection gets stronger with Bitcoin and digital rents, because you're you're just gonna have it's just gonna be in my opinion, just a better business environment overall. You're,
Absolutely. I couldn't agree more. And I mean, what you're describing with, the deal structure, I mean, that's a unique situation. I realize that happens. It happens, right? It's not a one-off. But there is also a little bit more of a, what's the word I'm looking for? I don't want to say formal, but um, a different approach to it. And particularly in the retail sector, you have what's called a percentage lease. So, and it's kind of like a profit share. I mean, the tenants are still paying a fair market rent, but at a certain point, once their revenues from the business hit a certain hurdle rate, every dollar over that hurdle rate is then split between the tenant and the landlord. That's called a percentage lease. And the reason for something like that is, or at least the thought behind it, is it incentivizes both parties to keep the property in a high caliber environment, right? Incentivizes the landlord to keep up the maintenance and the landscaping, and do everything they need to do to bring people to the center. In turn, the tenants' revenues are higher, and everybody benefits from that scenario. So there's a couple different ways that the scenario you're describing can go down. Some are just a little bit more formal than others. Some of your first comments there, Kenny, the one of the common themes in the CRE industries across at least the last decade, the best performing assets have two things in common. One, they're high quality assets, right? They're class A trophy properties. And two, the landlords were very intentional and methodical about the tenant mix. Those are two critical components to having a successful CRE property. And the ownerships that don't focus on that, I don't want to say they cut corners, but it's not necessarily a focus of theirs. They see it, especially the last couple of years with rising costs and work from home and online e-commerce and all these different secular trends that are impacting different areas of the real estate market. And the landlords and the properties that are the highest quality are outperforming everything else by a notable margin. And I
one
don't see that
one
going away.
one other thing I was just thinking about as I was listening to you is most of our leases are triple net leases, and you have CAM expenses, common area maintenance expenses, and that could be snow plowing, it could be landscaping, it could be um, some landlords will use it for parking lot improvements or
Mhm.
HVAC improvements, that type of thing. But I started thinking about, what if property owners started putting a percentage of the CAM payments into Bitcoin? So when there was a big improvement, like a parking lot or a roof, HVAC, the operator or the tenants wouldn't have to come out of pocket to pay for their share of the improvements.
Yep.
So I think there's just going to be so many different ways that you can apply Bitcoin and digital rent, and it's going to have so many second order effects because of it that like we can't even fathom all the different things that are going to be unlocked from this.
Absolutely. Think about all the different income streams in real estate, and all of them have an expense component to it, except your digital rent, right? So, and that's what I'm trying to like impress upon the real estate folks here is yes, you have your rent in place and you have all of your expenses. And just real quick, before the person slides into the comment section and says, well, I have triple net leases and my tenants pay all my expenses for me. Like, reconsider that viewpoint because that's very nearsighted. If you think your tenants are going to pay your double digit expense increases in perpetuity, you have no business being in the real estate business, full stop. So when you think about these expenses that are compounding at double digits year over year, right? Your rents aren't keeping up. Your rent from your liquor store, your tennis shop, your coffee shop, etc., they are not growing 10+% per year. So you have to go out and you have to find other areas of income. A lot of people bring on a cell tower, they bring on billboards, they charge for parking, right? They charge for different amenities. Well, you now have a new option. It's called digital rent that doesn't have any expense, it doesn't have any drag, that can help you bridge those issues. And it can make your NOI more resilient.
A little off topic here, but I saw that you did a note on X about a hotel company, another hotel company, not
Yeah.
MetaPlanet, but it looks like the second hotel company to adopt a Bitcoin treasury, and
Mhm.
they're going to potentially start accepting Bitcoin. Can you tell me a little bit more? I just was scrolling this morning and was just curious.
Yeah, Murano Hospitality. They're a publicly traded hotel operator. I believe the ticker is MRNO, and I think they're on the NASDAQ if I'm not mistaken. But Murano Hospitality owns and operates hotels, hospitality assets throughout Mexico and Latin America. They may have some assets in the US. I don't know offhand, but their CEO and founder is a diehard Bitcoiner, and they introduced a Bitcoin treasury strategy, I think 2 years ago, 2 or 3 years ago. And they're also exploring the loyalty program. How can they get their customers to how can they integrate Bitcoin into their loyalty programs for their customers? I think that the next logical step is obviously accepting Bitcoin for hotel fare for your fees there. I think that's a logical next step. But to see that they are actively exploring different ways of integrating it is incredibly exciting. And again, this isn't just some run-of-the-mill shop. These guys are I think a $2 billion company, publicly traded, have dozens of assets throughout Mexico and Latin America, and they've seen the light. They see where the puck's going, and they're doing what they can to be. I mean, I guess in this case, to be a second mover, but that's still very notable. And the big difference there too is they're using Bitcoin as a hedge, right? A new tool to enhance the real estate. They're not doing what MetaPlanet is, and all this financial engineering and securitization on top of Bitcoin. That's a completely different strategy, a completely different business model. And I think that kind of underscores or points to one of the current talk tracks in Bitcoin and Bitcoin treasuries is, are there too many treasury companies, right? I mean, I think each of them are serving different segments of the market. They're solving different problems, and that's a good thing. Some of them are going to make it, some of them aren't. At the end of the day, I think all of us and the industry will be better off for it. If
Yeah,
you're in,
I'll go ahead and say there's not enough treasury companies because there's a 200 out of what was it, 400 million. It's kind of absurd to think that there's too many treasury companies. When you know, same thing from the .com area. Is there too many tech companies? Too many websites? How many
yeah,
websites are there now? Like everyone has a website, whether you're a business or just an individual. You probably have multiple websites.
yeah.
Um, so
It's just early
um,
days, and it's the institutionalization and the further adoption of the asset, and we're going to see a lot more of it. So buckle up and grab your popcorn. There's going to be no shortage of excitement along this road.
I know we're coming up on time here. I did want to mention one last thing that came up, on the spot here while we were talking. Another use case for Bitcoin, deposits. When when you lease a space, it's 2, 3 months, or depending on what business the landlord may require you to have even more of a deposit. Now, what happens if the landlord is willing to let you put the deposit in Bitcoin? And they say, hey, we're going to split the upside of this Bitcoin. And you're doing 5, 10 year leases, right? So you come
Yep.
back in 5, 10 years, and the Bitcoin could have appreciated more than your business earned in that period of time.
Absolutely. I love the fact. I'm glad you brought that up. I've had this conversation offline with a few folks now, and there's a lot of ways you can approach that. One is, like you just said, splitting the appreciation. And it doesn't necessarily have to be a 50-50 split. You can negotiate that split based off the circumstances of the deal. The other option is, it's basically a self, pay. It repays itself, right? It's like, so if I have to write a deposit for 250 grand, right, over a 10-year lease, rough numbers, right? And once that Bitcoin appreciates, it covers the initial obligation. You get it back, right? The landlord's risk has been mitigated.
Yeah, imagine
So
like at
there's
the end of a 10-year lease that you're all right, we're gonna buy our own building now, or we're gonna move, or we're just closing up shop. And instead of the landlord saying, well, you left these holes in the wall, there's the sign that I gotta take down, your deposit's gone. Instead of
Mhm.
them telling you your deposit's toast, they're cutting you a check for $1 million, $2 million, whatever it is, right? And that could be
Yep.
just like a wild, you know, thing to,
I
yeah.
mean, think about like we have this phrase, you'll come across the phrase, midnight move out, every once in a while. And basically that's when a tenant, large or small, they get squirrely in the night, and on Monday morning there's no one there, right? And they leave all their furniture, all their equipment, and they just say, we're out, right? And make the whole thing the landlord's problem, right? You'll see that somewhat regularly. So if it'd be interesting to see how the behavior changes, if and when a tenant has to put up that deposit in Bitcoin, right? I don't know how that plays out. Do they still just say, DGAF and move on and do the midnight move? Or do they say, hey, I have a situation here. Business isn't doing as well as I thought it was going to. We lease too much space. Let's work this out, right? That'll be interesting. I don't have a good answer for you on that, but it would be that'll be interesting to see play out over years and over time.
Now I'm thinking, what if you split the deposit, maybe you do half stretch and you do half Bitcoin. Now you're turning deposits into revenue streams.
Yep.
That
Yep.
is awesome.
Exactly. Exactly. I mean, most leases read that the deposits are held in, non-interest bearing accounts. That's a bunch of crap. That needs to change. And why not hold it in stretch? Why not? I mean, all this. So again, you're when you start to think about, when you step back and look at all the possibilities that we're talking about here, you very quickly find yourself in a scenario as a real estate investor, a real estate operator, with a tangible, practical path to exceeding the Bitcoin hurdle rate. Right?
Well, yeah, I mean, you're essentially going to have a bunch of different stacks of Bitcoin if you maximize these strategies, right? You'd have your dollar cost averaging stack. You could have your deposit stack, your common area maintenance stack. You could have a lender that is going to split appreciation to the upside, and you have excess Bitcoin stack that's financed. Um, and they're all appreciating and working for you and improving your property. I just think that the future is orange, and that's
So
all I can say.
in the future is orange. And in conclusion, to the real estate investors out there, don't sell your real estate. It's not going to zero. It's going to be, you're going to turn it into, you have the ability today to turn your real estate asset into a money machine. You heard it here first.
An orange cash cow.
An orange cash cow. There you go.
I've got a new one for Chat GPT. Go ahead, Tim. Sorry.
Yeah, we need a meme for the orange cash cow. I think that could be like a whole logo in and of itself.
Yeah, absolutely.
I was also thinking on your STRC comments, Kenny, and in the same way that if you have 100 people, you probably have 100 different opinions on where interest rates should be with the Fed at any given time, to hit on another hot topic. So in the same way, I'm sure you'll have some disagreement, at least amongst individual investors, on where the rate should be up or down or unchanged on these preferred products. So what happens if, they could lower the rate on STRC, for example, but maybe they don't lower it as fast as they could, because instead of issuing 100 million or $1 billion worth of shares every week to buy Bitcoin, they do 10 times that, and they can buy $10 billion or $100 billion a week. And they're like, yeah, we'll sell more shares in the market, no problem. Everybody just come on and collect your 12% or whatever it is. Like, I think that could be really interesting. Interested to hear your thoughts, if that's too crazy, or, I mean, because you want the arbitrage to be there. You don't want to pay more than you have to, but also if you know that Bitcoin is pristine collateral and you're just trying to stack as many millions of Bitcoin as you can, like, why not?
I think that now that you said that, I can remember Saylor talking about, why would we lower the rate, because people aren't, we're going to have more buyers. What you're saying is you're going to have more demand. The higher the interest yield, the rate that you're earning, the higher the digital rents, to make it easy. The higher the digital rents, the more people that are going to want to own those digital buildings. And I think you made a great point there that if they lower those rates, then there's less buyers. So
I don't know what just happened, but it was a cool visual effect. It almost looked like you went off the screen and then came back up into the screen. So
Kenny's so excited about digital income, he's doing backflips on the live stream. No, I think,
yeah, I have another call coming up, so I think my phone rang, and that's what happened there. So
gotcha.
Very cool.
I mean, Tim, I think if you go into this ZERP environment again for whatever reason, you just think of the inflows that products like Stretch start to garner. If you're paying 10%, right? That's, I think, the scenario that we're talking about here. Saylor's already planned for it, and he's actually thinking that is going to happen. And ultimately, in that scenario, is that What did he say in his presentation? I think the total addressable market for a vehicle like Stretch was like $400 trillion. I don't know if I have that stat correct, but it was a massive number, right? It was the bond market, it was money markets, all of that. I mean, is that the environment you need to, steal that market share? I don't know.
Well, he talks about, how there's going to be tons of digital credit products, right? And I guess my point is if strategy doesn't do it, someone else can do it in the future and make one that is designed specifically for commercial real estate. And I think Stretch is pretty close to that. And the commercial real estate or the real estate market in general is like the $300 trillion gorilla. But I think Stretch is super close. If it had like a 50-to-1 conversion component, I think it would, like just something to address the upside potential. Because with real estate, those properties are going to appreciate, and they appreciate slowly, but nevertheless, like you have property owners, commercial property owners, that's how they think. Why are they going to, they're to get them to buy something like this, it has to check the boxes. Do they have upside, um, you know, um, built into this product? And I think that's the one thing that it's lacking, and that, and potentially like maybe the next one is similar to Stretch, but it's fixed. So maybe it's slightly less. It's not 11%, but it's a point down or 2 points down, and it has a conversion component. Maybe not as attractive as STRK, but pretty close, or maybe 50-to-1 or something. We're gonna have to brainstorm on the next call, because I think a few of us have to jump off here today. But this was great, guys. Thank you.
Absolutely. Any final brief thoughts, or we'll wrap it up right here? Kenny, Chris, thanks for your time. This has been episode 4. We're going to be dropping the studio episode later today, and we'll announce an X Spaces that we're going to do tomorrow. So stay tuned, and we'll see you back here